but we're going to score changes now on the mortgage industry side. So going forward, and we'll talk about the rollout and what that rollout looks like, lenders are going to have to provide both the FICO 10T and the Vantage scores to Fannie and Freddie. So FICO Classic is now going to be a thing of the past, and it's been used for over 20 years. The score was created in 1989. The newest version of FICO, FICO 10T, is going to be incorporated. And in addition, lenders are now going to have the ability to use both the FICO and the Vantage scores to qualify borrowers. So let's take a look in more detail on how we got to this point. So in late 2020, Federal Housing and Finance Authority, again, FHFA, announced that the other credit scoring software, the new version of FICO and the competition Vantage score, were going to be evaluated. And now it just got approved, okay? So let's look at the differences from what you're used to now that we reviewed and what's going to happen here with the rollout. So these are some of the more impactful differences I want you to be aware of. So the impact of late payments is going to be more pronounced than it was with prior FICO score versions. So a new late payment is going to have a bigger detrimental impact on the credit score. So consumers who miss a payment are likely to see a more severe drop in their scores under FICO 10 compared to what they've seen today. And that's from all FICO versions, not just Classic. FICO 10 is also unique in that the way it looks at personal loans is very different. So if you've worked with our team, you may have heard us talk about consolidating credit card debt into a debt consolidation loan to help boost the score super fast. That may be a thing of the past in many scenarios. So you're actually going to be penalized in FICO 10 for personal loans, where traditionally you see that score bump from a personal loan. It's considered more high-risk debt for somebody who has trouble paying off debt. So the algorithm is essentially looking at it as a negative. And then let's see. There is a suggestion, and I need to talk to FICO about this more. The great news is we do have a liaison with FICO that we can communicate with to get a bit more clarity on this. But some of the information that's come out is slightly conflicting, saying certain consolidation loans for credit cards will be looked at favorably while others will not. So we need to find out the details there so we can more adequately advise consumers. Here's some good news outside of this bad news. So some silver lining, rental data is going to be included, and a lot of this credit building tools that exist, like Experian Boost, you may be familiar with, are now going to be pulled into these score models and going to help the credit scores a lot more. So you've got more options available to boost credit scores that you didn't have before. Collection accounts, they're going to be treated differently in a more favorable way for the consumer. Any questions about any of this so far? Okay, let's move on. Okay. Here's the biggest change, trended data. So the newer credit scores are both that Vantage 4.0 and the FICO 10T, the T stands for trended, are including trended data. So who here has used Rapid Rescore or Wayfinder? I'm sure everyone here has at least one point. Yeah, I saw Jason raise his hand. With trended data, we are now looking at consumer behavior over a 24-month period. That means we're averaging our spending or usage of credit cards over 24 months. So they want to look at and categorize consumers based on those behaviors to better assess risk. So somebody who is carrying balances long-term is going to be looked at very differently than somebody who is a transactor who uses their card to the maxes their card out every month and then pays it off, and maxes it out every month and pays it off. So there's some pros and cons to this. Today's model is more of a snapshot, right? If you pull your credit today and your credit cards are all maxed out, you're going to see your score be a lot lower. If you pay them all off and you do a rapid rescore, or your creditor has now reported your updated balance to 0, and you pull your score, you see your credit score shoot up, right? It's a big variance you can see from day to day. The idea of the new model is to eliminate this big variance or this volatility that can exist from that. So when I say the last 24 months, this means everything that a consumer is doing today, through the next 23 months, this month through the next 23, 24 months, is now going to be considered in that credit score that they have 2 years from now. So it's really impactful, really important to know that this is affecting consumers right now. Excuse me. Okay. So let's look at these new categories that have not existed previously. The transactor and the revolver. These are the new categories, right? I guess labels, if you want, for consumers. Now this slide, as you see, comes directly from TransUnion. So this is already what's being implemented in the FICO models. So with the trended data, the credit score is looking at, like I said, who carries the balances versus who pays them off. Okay. So why does that matter? If we look at these consumers, consumer A is somebody who's paying down credit card balances. Consumer B is somebody who steadily uses their credit cards, steadily maintains the balances. And consumer C is a balance builder. Over time, their balances are increasing. With today's credit scoring, standard credit scoring, they would be at a 675. So every single one of these consumers would have the same credit score. Okay. What's changing based on the way they interpret the data is some consumer A who's been paying their credit card debt off over time now would have a 750 credit score. So they're now being rewarded for the gradual pay down of their debts. That's very different than anything we've seen before. Somebody who's a steady user is going to be at a 680 with this new model. That means if they just went and paid everything off and you did a rapid rescore, you're not going to see this giant bump in their credit score, right? And then somebody who is increasing their debt over time, we're seeing it steadily build up, is going to have an even lower credit score than they would otherwise because it's more risk, right? This person's taking on more debt and has the inability to pay it off. So the whole idea is to better assess risk across the consumer base.